Power to the players. Can't stop, won't stop. GameStop.
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 GameStop? I'm sure you've heard of GameStop.
This crazy GameStop stock market story.
GameStop caused the stock market to collapse under its own weight.
GameStop? More like Game Don't Stop.
This is the story of how Keith Gill, or Roaring Kitty on YouTube, or You Deep Fudging Value on Reddit, and Michael Burry from The Big Short cashed out millions and predicted the historical GameStop short squeeze. Let's rewind all the way back to June 2019. Keith Gill is 32-year-old security analyst at Mass Mutual Insurance Services. He buys his first options call for $50,000 on ticker GME, GameStop's abbreviated name on the stock market. Founded in 1984 and step-parent to millions of children across North America, the now 35-year-old video game retailer had fallen on some rougher pastures. With the rise of online e-commerce, digital downloads, and the dwindling popularity of physical retail stores, GameStop stock had fallen from its previous high of $55.05 per share in 2013 all the way down to a measly $5.63 per share. Seeing its fall from grace, big money hedge funds like Melvin Capital, Point72, Citadel, and D1 Capital Partners began to place shorts on GME, hoping the stock would fall even further. Shorting a stock means you're placing a bet that the stock will go down. Investors and traders, whether they're your everyday retail trader or a big hedge fund manager, make money from shorting stocks the same way. First, they borrow a stock from a broker, like Robinhood or Webull, at its current price. A broker, by the way, is just the middleman between people looking to buy a stock and the company whose stock is listed. After these traders borrow a stock from the broker, they immediately sell it. When the stock moves down in the future, these short traders buy back the stock at the lower price and pocket the difference. Voila! You just profited by predicting a stock will go down.
And that's cool to see. That's real cool to see.
But what if the stock's prices go up instead? Well, for every dollar that price goes up past the point you sold it, you lose money. It's basically like selling something you have for $8, but then having to buy it back for $16 or $24 or $100. Technically, you could just never close your position, meaning you keep your trade open as you continue to incur more and more debt. This also means that you could lose an infinite amount of money as long as prices continue to go up. The thing is, what if you run out of actual money? With shorting, you eventually have to give back your borrowed shares, whether you take a win or a loss. At the time in 2019, over 50% of the outstanding shares on GameStop had short positions. Melvin Capital in particular had been charging up a massive $55 million short against GameStop stock. With things looking so bleak for the video game retailer, what then did Roaring Kitty and Michael Burry see that made them so optimistic on GameStop stock almost 2 years before the 2021 short squeeze? A change in management. Contrary to popular belief, GameStop's epic rally in January 2021 was based around more than just hot air and hype from stimulus-backed Redditors. What actually started the eventual series of events was the election of new leadership for GameStop in mid-2019. Former CEO of the multi-billion-dollar pet brand Chewy, Ryan Cohen, came into a leadership position within GameStop along with new CEO George Sherman.
Ryan Cohen, cheers to you, my man. Cheers to you. Congratulations to you. Just what a move, right?
They had one goal in mind: to revitalize the dying video game mall retailer. Their angle? Use the company's existing brand and large base of raving customers to revitalize their in-person stores and make a major shift into the e-commerce space, eventually competing with online gaming retailers like Steam, Amazon, and Blizzard. Always on the lookout for new opportunities, The Big Short's Michael Burry buys into GameStop a few months later in Q3 of 2019. His private investment firm Scion Asset Management reported $GME as the biggest bet in their portfolio. owning up to 1.7 million individual shares of GameStop as of September 2020. To put that into perspective, if they held during GameStop's peak price of $483 on January 27, 2021, Michael Burry's portfolio would have been worth over $821 million just from GameStop stock alone. From just $17 million in September of 2020, this would have been a massive 4,800% gain in just under 4 months. Did Dr. Burry have a crystal ball? What did he see that allowed him to first predict the housing market in 2008 and now the 2021 GameStop short squeeze? Well, Burry is what's known as a value investor, which means he invests in stocks of companies that he believes have good business foundations for future success. He actually has 5 key principles he follows when he does this. 1. Don't copy other investors. Now this point might seem a bit contrary to what this video is about, but hear me out. In the book, The Big Short, Michael Burry says that if you're going to be a great investor, you have to fit the style to who you are. At one point, I recognized that Warren Buffett, though he had every advantage in learning from Ben Graham, did not copy Ben Graham, but rather set out on his own path and ran money his own way by his own rules. In other words, don't just blindly copy other people's strategies, do your own research first and adapt their findings to your own system. For example, Warren Buffett has an amazing investment strategy that revolves mostly around banks. He knows banking and understands it. GameStop, on the other hand, maybe not so much. Obviously, this rule sounds like it's common sense, but with FOMO and once-in-lifetime opportunities coming and going for what seems like every few months, it can be tough to follow. Just ask any of the millions of traders who've lost money in the stock market or in cryptocurrency. At the very least, if you're going to copy someone, then do your due diligence first. This brings us to our second point. You have to learn about it yourself. In the words of Wall Street Bets, do your due diligence. Go on sites like Yahoo Finance and FinViz to help you get started and stay up to date with current events. And if all else fails, there's some surprisingly detailed posts on Reddit to help you with your research. Just be sure to look at the comments to see some other takes on the information. 3. Have confidence in yourself. Not only did Michael Burry predict the housing market crash in 2008, betting against the American economy itself and even his own financial investors, but he also started investing into GameStop in 2019, a time when GameStop shares were still trading as low as $5 per share.
And I was extremely confident in the outcome.
But make no mistake, this confidence comes from rational thinking and deep fundamental analysis. It does not come from arrogance or seeing yourself as some sort of investing god. 4. Don't be afraid to be a contrarian. If you haven't realized it yet, the reason why Michael Burry and those who got into GME early on made so much money is because they were going against the herd. Most people thought GameStop was done for, due to the rise in popularity of digital downloads. Same thing with people who invested into Tesla in 2018, 2019, and early 2020, before Tesla's historic bull run. To catch these big moves in the stock market, you usually need to be going against what's popular in the mainstream. Here's something to keep in mind. If it's already made the mainstream news, it might just be too late. By the way, that's not to say that you always have to be a contrarian to make money in the market, but it can definitely help. 5. Always be searching. While it's always best to invest in things you already know, if you aren't familiar with certain stocks, whether it be tech stocks, electric vehicles, or gaming companies, you can get familiar. Michael Burry is 49 years old and just invested in GameStop in 2019. While we're not too aware of his gaming history, I think it's safe to say that he won't be keeping up with the latest Cyberpunk 2077 glitches. If you see an opportunity, go for it. Just do your research first. These are the 5 principles Michael Burry uses to be an extremely profitable value investor.
And this is how I educated myself on the sector.
Do you know who else is a value investor? Keith Gill, also known as Roaring Kitty or You Deep Fudging Value. The man who kickstarted Wall Street Bets into its history-making $ GME short squeeze, Keith got into GME in May of 2019 with an initial investment of $50,000. What made him do it? Well, seeing Michael Burry buy it certainly didn't hurt. But Keith had his own criteria. It included 3 things. The first being plenty of downside protection, making it unlikely that the stock would fall. To give some background, the gaming industry is booming, with a total value of over $150 billion. With over 60 million Power-Ups Rewards members and a positively cash-flowing business, GameStop actually managed to remain profitable throughout the late 2010s despite its bleak outlook. At the time, Sony's PS5 and Microsoft's Xbox Series X were set to launch within just about a year, a huge opportunity for GameStop to generate even more cash flow that could be used to improve the business through things like in-store gaming experiences, partnering up with vendors to showcase games, and fleshing out their e-commerce capabilities. For a company with solid financials and cash flow positive, GameStop stock was severely underpriced at the time Keith bought. After all, it is the only brick-and-mortar store dedicated to gaming. The second is that GameStop's legacy business is probably worth between $500 million and $1.5 billion. With over 5,000 physical stores and 60 million Power-Up memberships, GameStop is unique in the gaming space. And with partnerships with companies like Activision, EA, and Nintendo, GameStop has the opportunity to provide a truly unique online and in-person experience. Finally, there's a non-zero chance that GameStop successfully reinvents itself. With new leadership, extra cash, and now massive hype, the future looks bright for the 35-year-old game store. Put together, those 3 criteria made GameStop one of the most asymmetric or one-sided bets in the stock market, at least according to Keith. He shoots for 50 to 150% annualized returns on each trade, which is very aggressive since most investors are lucky to see a 10% return each year. But to achieve these higher volume returns, Keith has to invest in riskier companies, businesses that could either bust or boom within the next couple of months or years, like GameStop back in 2019 or AMC while theaters were shut down. The best time to buy a stock is when the market is tanking. As they say, buy low and sell high. By September of 2019, his portfolio had more than doubled in size to nearly $130,000 worth of GameStop stock. 1 year later, by September 2020, it had doubled again in size to over $250,000. Then, in the span of just 4 months between September 2020 and January 2021, Roaring Kitty's initial $50,000 investment ballooned to over $48 million, making Keith a multi-millionaire in just under 2 years.
Whoa! Oh, damn, what a day.
He wasn't alone either. Thousands upon thousands of Redditors and everyday people began to jump in on the action. Fueled by the additional income from stimulus checks, Wall Street Bets transformed normal everyday people into stock market savants. This was the final nail in the coffin for hedge funds like Melvin Capital, who shorted GameStop. Once Wall Street Bets Redditors discovered their overloaded short positions, publicly available information known as listed put options, it was game over. In a frenzy, Wall Street bettors reacted by intentionally buying the stock to bankrupt Melvin Capital, a short squeeze, the attempt to push a stock price high enough to force potential shorters like Melvin Capital to close their positions or risk losing even more money in the process. The catch is, if a hedge fund were to close their short position and take a loss, they would have to buy back GameStop stock. This means that hedge funds closing their positions would just push the buying pressure of GameStop even higher, helping retail investors and Wall Street Bets bandwagoners. On January 12th, 2021, GME's stock price was at $19.95. Then, on the 13th, it jumped 57.39% to $31.40. It grew steadily over the next few trading days before hitting $43 on the 21st and going parabolic, going up to $63 the next day, to $148 on the 25th, and finally peaking at $438 per share by the 27th of January 2021. This was an enormous transfer of wealth from the hedge funds to retail investors. There's this guy who had $11 million worth of GME with a jump of over $3 million in a single day. There's this guy who paid back his $23,000 student loans from his gains. Then there's this dude who invested $50,000 in and made $250,000 in one day. Even Elon Musk got in on the action, tweeting GameStonk with a link to the Wall Street Bets subreddit. Meanwhile, billionaire hedge funds who had shorted GameStop stock were losing boatloads of cash, totaling up to $19 billion in the end. Melvin Capital's borrowed shares were due, but Redditors refused to sell, pushing GMEs higher and higher. The hedge fund lost over $2.75 billion in just about 2 weeks and had to get bailed out by two other funds, Citadel and Point72, just to cover their losses from the shorts. But big money wasn't finished just yet. In a surprise move, Robinhood and other brokers restricted trading of all Wall Street Bets-inspired meme stocks including GME, AMC, and BlackBerry, pushing down the price of GameStop stock specifically from its all-time highs back down to around the $100 per share mark. You could sell the stock, but you couldn't buy anymore. Why did the brokers do this? Today, retail trading is easier than it's ever been thanks to the rise of commission-free trading brokers like Robinhood and Webull. Traditional brokers charge you whenever you place or withdraw from a trade. Commission-free brokers, on the other hand, allow you to place trades to your heart's content, as long as your bank account allows for it. But if a broker is commission-free, then how does it make money? Data. Robinhood and other commission-free brokers act as a middleman between you and prime brokerages. In other words, hedge funds like Citadel. If that name sounds familiar, it's because Citadel is one of the hedge funds that bailed out Melvin Capital after it lost billions of dollars to Redditors in the short squeeze. Robinhood takes your data on the trades you place, a set of information called order flow, and relays that information to prime brokerages and hedge funds like Citadel. Citadel then takes that and uses it to predict what stock they are going to buy or sell next. In other words, one reason why hedge funds are able to make so many profitable trades is because they know what their opponent, the retail traders, is going to do. In return for this data, Robinhood is able to raise funding from its investors, if you know what I mean. In fact, Robinhood has made over $700 million in selling user data to hedge funds. More than aware of the situation, the members of the Wall Street Bets subreddit, now over 8 million strong, filed multiple class action lawsuits against Robinhood. Not allowing people to buy stocks and only sell could be seen as a form of market manipulation, artificially pushing the price of stocks like GameStop, Nokia, and AMC down. Robinhood CEO Vlad Tenev said he was forced to shut down buying for certain stocks and raise $1 billion for the app in response to volatile market conditions.
There's a lot of volatility and a lot of concentrated activity in these names that have been going viral on social media.
He was famously grilled by Elon Musk later in an interview. So, what's the aftermath of all this chaos? GameStop stock dropped significantly, and while many Redditors were able to secure their profits in time, dozens of other retail investors lost hundreds of thousands as a result. This is the first time that social media has impacted the financial market space, but will it be the last? Recently, some of the most shorted stocks in Europe jumped 20% or more and are now the target of retail investors looking to trigger another short squeeze. In Tokyo, short-sold stocks jumped by over 7% or more. On the other hand, government organizations like the SEC are looking to place more restrictions on retail investing in response to the GME short squeeze. What does the future hold? Looks like we're gonna have to find out together. If you enjoyed this video, make sure to hit that like button and share it with your friends. For more videos like this, hit the subscribe button and remember to click on that notification bell. Also, be sure to check out our other videos as well. Thanks for watching.